Welcome to the Commercial Real Estate Mentorship Program, a clever alternative entity purchase versus asset purchase. I want you to think outside the box. In fact, I'd really prefer to have you get rid of the box, but I find that thinking outside the box is the best way to solve problems because we're not trapped in the world's limitations. I'd like to share with you how you could possibly get a nice property at a discount, plus have great existing cash flow, and not have to come up with the normal down payment you have to buy a office building or a shopping center or some other things. I'm going to give you a real-world case study. I think this is the best way to do this, that I actually structured the deal to help one of my commercial mentees buy a beautiful office building. It's detailed. I want you to understand it. It's one step at a time. I'm going to walk you through it just kind of the way I walked them through the whole process and tell you what happened and what we did. Let's talk about the idea of unconventional thinking strategies and work out just the perfect solution. This real-world case study is a classic entity purchase. Entity being the company. This happened to be a corporation. It could be an LLC. It could be something else that owns a property. Now, you have some rules, and I'll talk about those rules, what you need to watch out for here. But in this case, it was an entity purchase of a office building instead of a classic ordinary purchase where you just bought the building and got a new loan. One of my commercial mentees asked me to help him mentor him on how to purchase commercial real estate. Now, for disclosure, he is a bright guy with lots of credentials, but he didn't know anything about commercial real estate. He bought a home, he bought a couple of single-family houses, and he rented them out. But now he wanted to find out how to buy a great cash-flowing multi-story office building with a high net operating income, strong financial leases in place, preferably triple net leases, and a way he could structure the deal so he could get it. So I contacted a real estate agent who's also a licensed attorney in that target area that he wanted to buy the building at, that I've worked with on several multiple commercial transactions over the last few years. I told him I already had looked over his website and all of his current listings, and frankly told him I've seen better listings and these shouldn't meet my needs. I've seen better listings on LoopNet and other places, so I need the best of the best for my client. I asked him if he knew of a seller of a nice office building that was willing to sell. And he said, I know exactly what you need. I don't have the listing, but I do have an agreement, a pocket listing. For those who don't know what a pocket listing is, whenever a real estate agent gets a listing, they must share with the board of realtors whatever listings they have or whatever the rules are for their firm within 24 to 48 hours. If you have a pocket listing, it's just an oral, unwritten agreement that if you sell their property for what they're asking for, they'll pay you a commission, which is exactly what he had. No formal listing, just a verbal agreement. I asked him about the office building, and I asked a number of questions that I wanted to know: size, location, net operating income, the existing tenants in place, the nature of their leases, the asking price, and the seller's terms. That made it pretty straightforward what he needed to find out. He hung up and he called the seller and asked the questions. I got answered all the questions and promptly called me back to say the answers to the questions were the following. He'd be happy to meet with me and my client personally, but here's his terms and here's what he wanted. He was very direct, very firm in his price and his terms, but he was willing to meet with us when we flew in to meet with him, and so we did. But the attorney told me, my agent, the building was a nice office building, beautiful black glass on a main street. It actually had a net operating income, real, legitimate, actual net operating income, NOI, of $311,000, which was all triple net income. Each one of the tenants paid their prorated portion of the property taxes, the insurance, and the maintenance. That's what a triple net lease is. That made it very attractive. The seller's price was absolutely firm, $3 million, which actually isn't bad because the cap rate based on $311,000, if it was real, and we proved it was real, was over 10%. That's awesome. But the seller's terms were cash to a new loan, absolutely no seller financing, period, and was adamant about that. So that would have meant that my client would have had to put up about $1.2 million cash down payment to a new loan for $1.8 million on a $3 million purchase. I flew in and I met with my mentees, his husband and wife, for breakfast. at a hotel which is just a few blocks away from the targeted acquisition, and went over the details with them, and they loved it. They thought it was awesome. They weren't quite sure how they pull it all off, and I said, let's just go look. We went to meet with the office building owner, who's an investor, general contractor, broker, and real estate developer. Hey, he's just like me, investor, general contractor, broker, and developer. We also met with the attorney agent and both of the mentees. We covered every square inch of the building. Every office we toured. During the office building tour with the seller, I engaged him in a number of questions and just asked him to tell me a story of how he bought it, how it happened, and understand what was going on and what he did. And he shared the whole story with me, every aspect of it. He bought 2 buildings, split the ownership, put this one in one corporation, the other one in another corporation, sold off the building that he split away, got the money back to make the purchase and minimize the down payment, and got a loan from a local credit union to do the build out because the building was basically empty. He bought this thing, big building that was just sitting there empty. I knew every nuance of what he'd done, how he did it, what he did, and got a scale of how much money he put in the building. I found out that he owned it in a single asset corporation, and he was the sole shareholder. He also said the corporation was new, had never owned any other properties. So this was a single asset entity. The corporation that existed had an existing $2 million loan with over 7, almost 8 years to go for the seller. So the building, the corporation, had a loan on it. That was awesome. Well, technically it was actually 1.99875 or something like that. But it was a $2 million loan for round figures. We had a chance to sit down for lunch in the ground floor of the office building at the restaurant that was a tenant of his. And we spent 4 hours inspecting the building and an hour having lunch. At the conclusion of it, everybody was ecstatic. The seller was interested, liked meeting us, liked meeting the client, might like meeting me, and good to see his friend, the real estate agent broker. Now, my investor mentees and I met privately to discuss this whole matter to see what I had seen and heard in the building tour. My mentees were just jumping up and down, excited about this property. $311,000 triple net income for only $3 million. That is absolutely, and a 10 cap. And the reason I found out he wanted to get rid of it, because it's a great cash flowing property. But he had a chance to do another couple of deals. And he had some hot deals he wanted to do that could make him even more money. And so he wanted this gone and sold. I had to, unfortunately, add a dose of reality to them saying, yes, it's a great deal. It is a great deal. But let's ask the question for you guys. Simple, straightforward. Do you have liquid $1.2 million cash for the down payment to a 60% $1.8 million new loan? Because those are the terms of the seller. Cash to a new loan, no seller financing. They were quite shocked, a bit taken back, and answered very, very unhappily, no. They didn't have, even if they sold all their student rental homes, they would not have enough cash to do this deal. It was out of their reach. So before they got too depressed or too upset or too caught in the situation, I said, I got a question for you. I have a creative idea how to minimize and eliminate, perhaps, their high down payment dilemma of $1.2 million. For first, we need to meet early in the morning with the seller's accountant to audit the records and verify that the NOI, the net operating income, is really the 311 actual income. So my mentees basically said, okay, we can do that, but what's the point? We don't have the money. And I said, the point is we're going to take this one step at a time. I've got a creative idea. I'll share it with you as we go forward. But for right now, we got to verify the NOI is the real deal. Now, my mentee and I went in, and he has an accounting background, so it was easy for him to do it. I just kind of looked at the tax returns and was there to ask probative questions of the seller's CPA. We already had an appointment set for later that morning with the mentee's local real estate attorney. The mentees were frankly a little skeptical whether they should waste time and money with their real estate attorneys. They didn't mind spending time at the accountant's office because that was done at no expense. But to have a nice real estate attorney sit down and talk about structuring a complicated, convoluted deal that they didn't even know how they could do it. Didn't seem like the best use of time and money. I said, trust me, it will be. And they did. So at the meeting with my commercial mentees and their attorneys, I asked the attorneys if they were open for creativity that would allow them, my mentees, to buy the office building with a $311,000 triple net we just verified. Both the mentees and the attorneys said yes, they were, but they were not sure where I was going or what I had in mind. I said, that's fine. I do. So I went to the attorney's whiteboard and I drew out the deal, the structure, using out-of-the-box thinking and creativity. I said to my mentees, you cannot just buy this building, this wonderful office building, because you don't have $1.2 million. But you love the building, true or not? Oh, we love the building. You like the net operating income? It's really real at $311,000? Yes, you do. So I asked my mentees and their attorney if they felt comfortable drafting a formal letter of intent, an LOI, based on my proposed deal structure. And they all agreed enthusiastically, curiously, and they were enthusiastic because they just had no idea what I was talking about. Let me tell you my out-of-the-box idea. You're going to draft a letter of intent as follows. The mentees will buy the shares of the corporation that owns the office building. The purchase price for buying the shares of the corporation will be $2.5 million. And they interrupted and said, the listing price is $3 million. And I said, I know. I didn't ask that. We're going to make a tender, an LOI, at $2.5 million. My mentee's down payment instead of $1.2 million was only $250,000, plus about another $25,000 for closing costs. And the seller would carry back $250,000 in spite of the fact he didn't want to. 5 or 7 years interest, only with the balloon. I prefer it to be the same term as the existing loan, so you don't have to pay it off early. They just sat there looking at the board. But what about the mortgage? And I said, well, by acquiring the entity, the corporation owned the office building, and when you own the office building, you would be taking over the existing loan by owning the corporation. The corporation owed the $1.9975 million. And they're just sitting there in total shock. And then he asked some questions if the seller would accept such a deal. And I said, I don't know. I like him. He's a nice guy. We're simpatico. We're like spirits. And I think if we present him the right alternative that we can close in a reasonable time frame and solve his problem, I think he will bend and say yes to an LOI, which will turn into a formal contract. I knew that the owner of the building had another commercial building project that he wanted to pursue. But in order to do it, he had to have this office building out of his hair and not slowing him down to even for a moment to pursue the dream of finding another creative real estate project and making another extra $1 million or more. Pretty nice. And that's certainly something for him that he needed to do. My mentees and their attorneys agreed to proceed forward to my unique creative entity purchase financing. My mentees and their attorneys asked if and insisted that I be the witness to sign the contract. And I was honored to do that. It also let the seller know that I was the architect of this deal. And good news, it was accepted by the seller. And they did get the deal accepted. There were some complications because the lender didn't want to let them be able to assume it. Well, they couldn't do it. One of the things I did at the CPA's office is I read the note, every page of it. Well, I'm not an attorney. I've been a real estate loan officer and a mortgage banker for 30 years. So I know what the rules are. They did not have a due on sale clause or anything about the transfer of ownership in the note. So they were caught in an awkward situation. They would not bend. Finally, they ultimately came back to my seller and said, you have a $200,000 personal guarantee. We'll let this deal go through. You stay on the note as a personal guarantor. Well, minor complication because the seller called my mentees and said, hey, I'm going to do this, but if I have a $200,000 liability out there or contingent liability in the form of personal guarantee, I want some collateral for that. And he asked for some additional collateral as a sidebar. Well, they called me up and I said, we're not going to do that. When I get the building, I said, I know. There's something that no one's seen in the paperwork. And in your due diligence, I'm surprised you didn't see it. But I did see it when I saw the paperwork and the tax return. What? There's an unaccounted for $80,000+ entry in there on top of the NOI as additional income. Well, I got everybody on the line. I had the seller's attorneys, the buyer's attorneys, me, accountant, investor with the knowledge of the whole deal who's buying it, and the real estate agent attorney. This long, complicated phone call basically went down this way. To the seller, and I called him by his first name, and I said, I'm just curious. When you did all those TIs for everybody, was the restaurant in place at the time? It wasn't. So you did the tenant improvements for them as well, correct? Yes. I said, Jack, could you have possibly gotten ownership or equity or some kind of piece of that restaurant? And there was a huge gasp on the phone, and I knew it was Jack. Jack fessed up that yes, those $80,000, that $84,000, $82,000, $81,000 were on his 3 last tax returns, were in fact his dividend from the restaurant for the ownership. As I recall, he owned a third of it. He traded part of his tenant improvements for the ownership. Is that a screaming good deal? Now, it's complicated. But if there's no reason you can't write an LOI and offer someone less than their full price, if you know they have an existing loan in place and your title company could verify that, you could look at the preliminary title report and get a good hint. You can get a preliminary title report and get a verification of what the number is. What the balance is, you'll have to verify with the lender. Now you have to be sure, I had his attorneys verify there were no liens or judgments against the seller or the corporation and verify that no other asset had ever been owned by the corporation. That was all verified. Once that was verified, the due diligence was pretty straightforward. They'd already done the audit on the NOI. We had to review all the leases, which were all triple net leases. Every last one of them. 100% of the building's property tax, insurance, and maintenance were paid in full, in advance, quarterly, to the seller. Now they're going to be paid quarterly in advance to the buyer. Entity purchase is a clever alternative. It's actually done all the time. Entity purchases are not that complicated. You need to just sit down and structure the deal to make sure you've got a clean corporation, no judgments, and the only asset in it has been the subject property, and do your normal due diligence. I hope that helps you because it is more than a clever alternative. Blow up the box. It's not needed. You don't need to have a box. You don't have to walk in the front door of the bank and say, hey, I'm on a $1.2 million loan, but I don't have it. How about going in a different window and talking to the seller about something that could solve his problem? In this case, it got the loan off of his personal name, except for the $200,000 guarantee. And what they did is they just made an arrangement to dividend to the seller prior to closing the shares inside the corporation to the seller. Now he has to maybe pay some taxes on the dividend, but that's not my problem. He got $80,000 a year, and it was a 10-year lease with 7.5 years going with a renewal option. Is that worth more than a contingent $200,000? I think so, and certainly the seller thought so. You don't normally have that kind of a quirk at the end of a deal, but if you do, you do what you need to do. You come up with the additional collateral to get $311,000 triple net. Well, guess what? Against $2.5 million, it's not 10% cap rate anymore. It's even higher. Try 13. A 13 cap? Impossible. Baloney. Nothing is impossible. It's only impossible if you limit yourself with your imagination and your creativity to be trapped in the box. Please get rid of the box. I hope this real-world example of how a mentee of mine did what was, in the world's view, impossible. It's possible. This is not mission impossible. This is mission possible. Only if you apply the creativity. This is what it's all about. Helping you become an informed, intelligent, commercial real estate investor. Take care.